Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for January 18th, 2020. Please see our disclaimer for important information. In our commentary this week, as we kind of transition to the second half of the first month of the year, I've got a little bit of news to report in terms of the recent data flow. Economic data has been maybe a little bit lighter, some of which we expected. Obviously, we're heading into earnings season. We'll talk about that. And then just this past week, kind of on the heels of all the turbulence going on in Washington with regard to the riots and things like that, we have more actions by the incoming president on what he wants to do in the economy. And so I think in kind of use the old adage, buy on the promise and sell on the news, we have the announcement of the $1.9 trillion stimulus package, which might have maybe underwhelmed people a little bit. Maybe we'll talk about that a little bit. We can certainly dig into some of the components and kind of our thoughts on that. But in any case, kind of talking about what to expect. We have an earnings season which is now upon us. We'll talk about where we stand here in early going of earnings season, but it's clearly going to be under great scrutiny relative to 2020, given the hopes for this economic recovery amidst this struggle to get vaccines out into the populace. But as we kind of prepare to dig in and all that, let's just go ahead and update you on the data. So the S&P 500 year to date is up about 32 basis points or 0.32%. S&P 500 was down 1.5% last week alone. Dow Jones was down 0.9% last week, and it's up about 0.66% for the year. Nasdaq also down 1.5%. The Nasdaq is up just a tad under a full percentage point this year. If you look at the Russell 2000 year to date, it's up 7.5% already, which is a phenomenal run in a relatively short period of time. Looking international markets have fared better. So the MSCI EFA index, which is one measure of the international market, is up 1.74%. The MSCI World Index is up almost a percentage point, and emerging markets are doing extremely well here out of the gate. They're up about 5.2%. Now, looking at bonds, we've had a little bit of a kind of a pullback in bonds. If you look at the aggregate, we've had interest rates move a little bit higher since beginning of the year, and the Barclays aggregate index is down about 0.8 of a percentage point for the year. Meanwhile, high yield and leveraged loans are both up for the year, so that we continue to see spread compression. We still continue to see high yield and kind of the more risky elements of the bond market perform exceptionally well. Now, if you look at real estate, we've retrenched a little bit. We're down about 1.14% on the real estate Dow Jones real estate index. MLPs are up pretty strong. Energy's had a fairly strong response because we've seen crude prices rebound. We've had about an 8% jump year to date in crude prices to about $52.30 a barrel. And gold is off a little bit. We saw about a high of $1,900 an ounce last year, and we're trading about $1,830 now. So we're down about a little less than 3.5% year to date. Dollar is up a little bit. I think it's almost kind of like a dead cat bounce. Last year, dollar was down about 7%, and I do think that we're going to be trending lower on the dollar on balance, as we head into the middle part of the year. But like I said, high yield spreads have come in, leveraged loans, really all of the riskier elements of the fixed income market have done exceptionally well despite this move higher in interest rates. Now, if you look at the 10-year Treasury, we're about 1.08 as of the end of last week, which is up about 17 basis points Year to date, 30-year is now about 1.83%, and obviously 3-month LIBOR is down about 0.2%, and that's down slightly from the end of the year. So, I guess the best way to describe this is we've continue to have this reflation trade, and which is really kind of dominating the markets this year, with the expectation of an increase in inflation of asset prices, with perhaps this hint of consumer inflation down the road. We've obviously had strong response out of small caps and cyclicals outperforming some of these technology firms. I guess notwithstanding the fact that many of the FANG stocks are under the microscope now for having made these changes on Twitter, cutting off Twitter accounts and cutting off parlor access from the back end servers and data centers and things like that. So there's been some noise in the tech sector, but despite that, we're clearly seeing some better response out of cyclical sectors. Right now, we've got an expectation for S&P 500 earnings to decline quarter over quarter and full year 2020, and for net earnings to finish about 15% lower in 2020 than in 2019. And we've talked about fixed income, and that there's expectations that the new Biden administration will bring further stimulus growth, but also perhaps some inflation. So you're seeing a little bit of an increase in yields there. Commodities I talked to about a little bit earlier. We've had some weak data. It's kind of interesting to see crude react so well despite a little bit of a pickup in the dollar, because it usually works the other way around. But the other thing I think related to gold, which is worth mentioning on the commodity side, is that with the change in the interest rate and the moving and the higher move in interest rates, we've actually seen the real 10-year Treasury, again the inflation-adjusted Treasury, rise as well, and so that has, I think, provided some fuel to gold, perhaps kind of reversing a little bit. But then again, on economic data, which we've got several pieces of news here. So retail sales were down 0.7% in December. That was expected to be flat, so that was a negative surprise. I guess I'm not terribly surprised to see a negative print in retail sales, but we had essentially what is known as a control group, which is kind of a more narrow set of prices and sales, of categories rather. Those were down almost 2%, and there was also a lot of downward revision to November data as well. So I think what this will do, because retail sales and consumer behavior weigh so heavily in the GDP number, that I think that could weigh on GDP expectations for fourth quarter, which we will get on January 28th. And then in the labor market too, we saw, we've had consistent growth in the labor market until just recently. And we had a initial claims number that was 965,000 in the week ending January 9th. And that's as high as that number has been since August. So all this progress made during the fall, we had this uptick. And of course, that was, relatively unwelcome news, if you will. But, I guess if you kind of look more broadly at what's going on, there's several concerns that I think we should be paying attention to in the margin. Obviously, we've got case volume. We always talk about COVID, and if you watch my charts of the week, we've got a lot of good data there. But we've got viruses surging. The 7-day moving average of daily new COVID-19 cases in the U.S. is around 254,000. The 7-day moving average of daily new deaths is around 3,300. And the number of people currently hospitalized for COVID is around 131. and all of these are, have surged in recent months and are now at all-time highs. And something else, we showed you this in the charts of the week, but this reproduction number is what a lot of people talk about, and so it's a index, if you will, and so anything above 1 indicates spread, that the number of infected people continues to grow. With essentially the implication is that the higher the number, the higher the reproduction, or the higher the infection rate. And right now that number is about 1.5%. So obviously we need to work hard to get that down. But we've got to have we have to continue to be vigilant in how we're addressing the virus. Mask wearing and so many other types of things, social distancing, that we still need to do amidst this vaccine wave. But we've had a huge, I think, a toe stumble on the vaccine out of the gate. And I want to say that we have, I know I've got some data here somewhere, but I think that number is around 10 million doses delivered so far, and I think that we were estimated to be about at least double that. So we're behind the curve there, but we've obviously, with a reproduction number of 1.5, we need to get more vaccines out into the public domain faster rather than slower. And so, we've got, we talked about this, the socioeconomic impact of COVID-19. The impacts there have fallen disproportionately on low-wage workers. Some interesting data points that I saw with regard to that, and this is done by Federal Reserve Board and the Federal Reserve Bank of San Francisco. They said that the employment rate for low-wage workers, which basically those making less than $27,000 per year, is down 25% compared with the beginning, or I should say the end of 2019. But in contrast, the employment rate for high-wage workers, and those folks are defined as making more than $60,000 per year, has essentially fully recovered and is now 1% higher. So a huge divergence there in that data. And something else that we've talked about rather consistently is the consumer spending impact of this. And we know that through all the stimulus money that came and went last year, and what has recently come and what's likely to come with the Biden administration package, and we'll talk about that, has driven basically checkable deposits in banks up. I mean, they've skyrocketed here in the last 6 months. But consumer spending in low-income zip codes, median household income of $46,000 or less, jumped quite a bit, whereas in high zip codes, and those were like above $78,000, had a much smaller increase. And we've talked about this a number of times over the year, but basically the lower socioeconomic layers that got stimulus spent it, and the higher socioeconomic layers actually saved it, and that's driven a lot of increase in bank balances and what have you. So let's see, and kind of continuing on the, let's see, let's talk about the stimulus package for just a little bit. 1.9 trillion. So with that, we've got, it's got additional direct payments of $1,400. Additional supplemental unemployment benefits of $400 per week. We have in that about $415 billion that's slated to go to kind of combating the virus and distribute vaccines. And within that number is about $350 billion to state and local governments, and then an additional $440 billion to relieve kind of hard-hit businesses. And so this is really important because I honestly, and I actually wrote in my 2021 Outlook that I was very skeptical that state and local governments would get a lot of money. Of course, That was before the Georgia runoff elections, and we know how those went. So, that is coming back into the fore. And so, the implications there, obviously, more direct payments. You're going to see a perpetuation of these spending and saving trends that I just described to you across the different socioeconomic layers. You're going to see that. And then you're going to see more consumption, probably more continued strength in durable goods. And this consumption demand that I think will continue to play out through the end of 2021. Unemployment benefits of 400 per week. I think that probably causes our unemployment rate to stay a little bit higher for a little bit longer. And then we've got obviously vaccine distribution, supplemental dollars, which is really important because that is the number one goal as a nation right now, is to get as many shots in arms as we can. So, there's likely some wiggle room in there. There's other things like a proposed increase in minimum wage, as well as a $3,600 per child tax credit that wouldn't phase out until you get to about $400,000 of income for married couples. I think some of this was thrown in there as fodder for negotiation. That the final bill, by everything that I can read, might wind up being around $1.5 trillion, but I think it still does include the state and local government subsidies, and obviously you're going to get more direct payments. So those are two hallmarks of this that I think will survive any subsequent negotiation. But this will be interesting because the market needs it. There's been a lot of testimony on the part of Federal Reserve Board governors and other kind of Fed talking heads, if you will, really trying to light a fire under the need for fiscal stimulus instead of the monetary stimulus that the Fed has been doing consistently throughout and expanding their balance sheet. But and I think this week even Janet Yellen is up on Capitol Hill for her Senate confirmation hearings as Treasury Secretary, and clearly she's going to echo that same sentiment. So that is that. Earnings season. What can we say about earnings season? Obviously, there's a lot of expectations built into this, and I think in some respects, I think these high expectations that have, as far as vaccinations and further fiscal stimulus and earnings growth and all of this in total is kind of set up the market perhaps for increased near-term volatility. Now, I do think the longer-term glide path is a little bit better, even with an uptick in inflation as we head into 2022. I don't worry about that because we've just had such low inflation relative to history that this economy is can run a little bit hot for a while, and we know that interest rates are going to remain low. But having said that, we talked about the pace of vaccinations has missed the goal. We talked about death rates and things like that, and that's not going as expected. And then stimulus out there, we talked about that maybe falling a little bit short of expectations, but we kind of don't know where the final number is going to wind up. But the other variable in all this is earnings season. So now we know that the S&P 500 PE ratio, we're kind of standing around about 23 times forward earnings, if you assume that those earnings are going to be around $170. But some of this is justified by the low rates we see. We've got a 10-year U.S. Treasury yield of about 1.1%. So, I think we're going to have to, have some reckoning here. So either we're going to have, higher rates, which I think could take some of the fuel near term out of PE ratios, especially if rates move fast. But I think that the Fed is going to want to probably put a lid on on any of that. So we're going to continue to see $80 billion a month in asset purchases by the Federal Reserve. They're going to really work hard to massage those interest rates that way. But the Fed has a lot more control over the short end of the curve, meaning short-term rates, than they do over longer-term rates. And we'll just have to see how inflation expectations play out here a little bit. One thing worth noting as we kind of head into earnings season is that small business confidence has dropped significantly. Yeah, I mentioned retail sales, I mentioned jobless claims, but that small business confidence number, which we had a chart on in Charts of the Week, is something we're going to have to pay attention to. We worry about the destruction. We've talked about some of the longer term destructive qualities of this pandemic, and to have confidence drop at a time where we really need confidence to begin to pick up and kind of look ahead is maybe a tad disconcerting. It's not worth sounding the alarm bells quite yet, but something we're clearly going to have to watch. But earnings. Let's see. Yeah, we've already begun to see some financials report. So far, we've had about 26 S&P 500 companies report, and which is about 5% of the index, I guess. 25 of those 26 saw positive earnings surprises, and 22 had positive revenue surprises. So here in the early going, a ratio like that, which typically sits around 65%, meaning that typically in a given earnings cycle, you have 65% of the companies beat their estimates on earnings. So far, with only 5% of the index reporting, that number is much, much higher than that. So I'd say that's a positive takeaway amidst some of these things that we're watching. But again, I think the main thing right now, as we kind of near the end of this conversation, is the vaccine rollout, and we really need to see that begin to take steam. One positive development, two actually. One, Johnson & Johnson's one-shot vaccine appears really close to being submitted for its EUA, or emergency use authorization. That's a vaccine that does not have to be stored at -80 degrees like the Pfizer protocol. And so it provides more supply of vaccines, and I think the other positive development is kind of the shift of saying we're not going to reserve the second shot and keep it in cold storage. We're just going to get as many shots in arms as possible and let the manufacturing backfill those second shots for the two Moderna and Pfizer BioNTech drugs that are vaccines that are on the market now. So that's good. So more people should be vaccinated soon. And if we can execute on this, especially with this change in administration and having this renewed focus on vaccinations, that I think we could get to a point, perhaps late March, April, where we might have more vaccines than people able to take it. Now that's, given the slow rollout to date, I don't want to put all my eggs in one basket, but that would be an upside case scenario that, we wind up getting to a point where we've got vaccines sitting in inventory waiting for people to come get them. And if we can also convince that maybe according to the Pew Research Center surveys, that the 16 or so % of the population that said that they're not going to get a vaccine, if we can convince them to actually get it, then that will obviously help ourselves out anyway, or as well. But so we want to keep our fingers on that. We want to keep our fingers firmly on this small business confidence number that I just described to you. We want to keep our finger on the pulse of spending trends for U.S. households, and we've got kind of this renewed risk aversion. And then kind of longer term, obviously we've got to deal with the higher debt issues, sovereign debt, fiscal deficits, so on and so forth. And then we've got other things on the margin, which Lord knows we haven't spent much time talking about, but Cold War with China, what's going to happen with aggregate trade, and really the ability amidst some of these other distractions that President-elect Biden is coming into the administration with, like impeachment and things like that. How is his first 100 days of governing going to transpire? So, so there's some near-term things that we need to keep our finger on the pulse of. Some longer-term things that challenges that we need to pay attention to. But clearly, the headline will be how we're distributing the vaccine and who's getting vaccinated and managing through all that. But I'm very optimistic, as we head towards the latter half of this year and into next year. We'll have, I think, a more normalized economy, and I think the equity markets and fixed income markets will adjust to that, and we'll have, I think, what we will kind of look back on as saying this kind of the settling out in the new market cycle. So at least those are the tea leaves for today, and I appreciate you listening. Thanks for spending the time with us today. You can see our information on your screen. Feel free to reach out via email or a phone call. And if you have any thoughts or comments or questions, we'd love to hear from you. Have a wonderful day, and we'll talk to you again soon.